Good morning, friends, fellow alumnus, ladies and gentlemen. It gives me great pleasure to welcome you all to the 65th webinar series organized by AABN and to know that I have your support. It made me proud to be a convener and even more hopeful about the future of AABN. I am honored to have the support of the core committee members and the participants and the inspiration that comes with it. The festivities will provide a wonderful opportunity to reconnect with fellow alumni and entrepreneurs and explore the ways in which AABN continues to shape an exciting environment. As we move forward to ensure the future of AABN, we will continue to invest in the vast potential inherent in collaboration among individuals of varying backgrounds, perspectives, and expertise. I thank you all for keeping a place for AABN in your lives and for your ongoing support. In the backdrop of AABN team building and creating confidence amongst entrepreneurs in changing market access and content, a few things stand out as guided by a finely honed invitation for further development. In brief, a greater integration needed within this diverse group of entrepreneurs and professionals allied to the new growth strategy. Against this setting, the chapter reach may be a pioneering attempt as it would encompass ideas in HR, technology, and business, bringing together ideas from different spheres of life, packaged in a viable form by prospective entrepreneurs. It will not only address a visible hole in the entrepreneur's fulfillment cycle that brings in a new thought process of how to look at a change in the context of an entrepreneur's upgradation role in growth and vice versa, while keeping long-term competitiveness firmly in the radar. Many of us have little understanding of finance, how credit works, and the possibility that poor financial decisions can create for many, many years. In fact, a lack of financial understanding has been signaled as one of the main reasons why many of us struggle with saving and investing. Consumers' knowledge about interest compounding, inflation, diversification, and bond prices are also limited, which suggests that the basic economic and financial principles that underpin these problems are widespread. Changes in consumer habits and financial products have made it harder for many to manage their finances. In the past, most people use cash for daily purchases. The way we shop has also changed. Online shopping is now the top choice for many, which can make it easy to use and overextend credit, and all too convenient way to accumulate debit quickly. Financial planning is long-term and people cannot depend on one-time windfall. Instead, individuals need to shore up the financial knowledge to manage the day-to-day financial lives while also taking longer view of the future. Well, most of us want to become financial expert, but we do not know where to start. Lack of financial literacy affects people who live in economically emerging or developing economies. Consumers have failed to demonstrate a strong grasp of financial principles that can help them understand and negotiate the financial landscape, manage financial risk effectively, and avoid financial pitfalls. We got an awesome speaker with fresh perspectives on Investopedia, the investment tips you will ever need to address us. Let me extend a very warm welcome to our eminent guest speaker, Mr. Babu Krishnamoorthy, to this interactive business networking session. Mr. Babu Krishnamoorthy is an investment consultant, founder and chief Sherpa at FinSherpa Investment Private Limited, a boutique wealth management firm based in Chennai, catering to financial needs of high net worth clients in India and abroad. A fellow of the Institute of Chartered Accountants of India, Babu has over 25 years of expertise in areas related to finance and money management. Prior to starting FinSherpa, Babu has co-founded Pelican Wealth and been associated with Allegro Capital, a leading investment banking with wealth management house. Apart from FinSherpa, Babu is also an advisor and co-founder at a revolutionary fintech startup, Roundups. Roundups caters to millennials and Gen Z in creating a unique method of saving and investing. A passionate thought leader in the personal finance space, Babu has authored the best-selling book, Unlock Secrets to a Wealthy Life, which helps young adults to start their investing journey in a methodical manner. As a professional speaker, Babu speaks on subjects relating to investment and finance. Babu is an avid reader of non-fiction books and is an amateur marathon runner. Babu is an active Rotarian and is a part of the Rotary Club of Madras East, where he is involved in various society uplifting projects. A past president of IFA Galaxy, one of India's oldest and leading association for mutual fund distributors, Babu has been at the forefront of helping the MFDs navigate themselves to a better place. during his presidency, he got 25 fellow distributors to co-author a book called Stay Hungry, Stay Bullish on how to build a robust mutual fund distribution business. Before I wind up, I reiterate that all your ideas, suggestions, and comments are helpful because it's only by keeping in close contact you can tell if we at AABN are doing the right things. I'm delighted to have enthusiastic individuals in AABN and look forward to a rewarding association in the years ahead. Thank you, and over to Mr. Babu Krishnamoorthy.
Thank you, Mr. Gopi, and welcome to all the friends at AABN. I look forward to a wonderful session this morning. Friends, one or two things I just want to say. Although I have 20 years of experience, I continue to believe I'm a student. I'm not the expert here. So I would kind of give you my worldview of what I know of money and finance, but I'm always keen to understand your perspective. So I will keenly look forward to the Q&A where we can share our thoughts. That's the primary. Second is, I have, like Mr. Gopi said, I have co-authored this, I've authored this book, which is called Unlock Secrets to a Wealthy Life. In any talk, there is, I always love to kind of see some enthusiastic people participating, ask questions, and be this thing. So with Mr. Gopi's approval, I would like to offer two of these books to the person who's going to be the most enthusiastic participant in today's session. So please be there. I will ship this to you individually on Monday. Two copies, two of the people who are seen as most enthusiastic participant in this session. That will be my way of, expressing my gratitude to you. So I will leave Mr. Gopi to decide who those two is, because I'm going to be busy with the presentation. With that, I'm going to get started, my friends. I have divided this presentation into three parts. And it's my fundamental belief that I hope my screen is visible.
Yes, please go on.
Okay, thank you. So it's my fundamental belief that all investments are essentially based on an economic backdrop. So either it's a global economy or an Indian economy. So it's important to understand from an economy standpoint where we are, because individually micro investing is largely influenced by how the macroeconomic conditions are. I'm going to first cover that portion for a little bit. And then I'm going to talk about investment products and investor behavior. These are two things. You may still have a great market, but if you don't have the behavior that investors need to adopt, then again, the wealth eludes you. So I'm going to talk about investment behavior. Then I'm going to talk about the myriad products that are available. Today, we are exposed to a host of different investment solutions. So I'm going to briefly touch upon, of course, I can't cover this in detail, but I'm going to touch upon each of these aspects and how these products stack up and give you a broad idea of this. And then finally, we're going to end this with my thoughts of what are the opportunities and threats over the next, say, a decade or so. So my presentation is going to cover only the Indian market largely, and it's going to look at what are the opportunities in the next decade. So that's where I am. Can I request you to kind of yourself mute so that we can kind of have a focused presentation? With that, I'm going to move. I'll take that as a yes. Thank you. So friends, this is a quote by Benjamin Graham. Benjamin Graham is understood to be the guru of Warren Buffett. We know Warren Buffett is the world's richest man, but Benjamin Graham is actually Warren Buffett's guru. So he said, and this is way back in the 1940s, he said, successful investing is not about money, it's about managing risk. I believe it's a very, very important thought that one needs to hold. And it's one of my favorite quotes of how we work with clients and money and so on, because it's important to address the risk. If you address the risk and if you cover the risk, the returns is there any which way. So it's very, very important. So managing money is about managing risks that way. So So 24 months, March of 2020 is when we kind of had this COVID lockdown start. COVID arrived out of nowhere. Like they say, the black swan event, typical black swan event was COVID. Nobody had a clue that we're going to see such a dramatic change in the way we all live and operate. Who could have guessed it? 2 years ago, January, none of us would have guessed in January of 2020 that for the next 20 odd months, we are going to have work from home, fits and starts, lockdowns, everything. The entire life, as we know, has been thrown out of gear in the last 20 plus years, 20 plus months. And guess what? We have all come out of it pretty successfully. Of course, there was some loss of lives and tragic in that sense, but a vast majority of the population has learned to live with it and adapt. And that's the quintessential feature of human life. We learn to overcome, we learn to adapt, we learn to evolve. So I'm going to give a quick summary of So I'm going to give you a quick summary of, am I audible?
Yes, sir.
Okay, thank you. So this is a sheet of how different economies have struggled and are struggling as we speak now in terms of coming together. In fact, the current variant that is creating havoc around Europe and better parts of the developed world is yet to come into India in that sense. So most experts I speak to tell me that February onwards, India will also see a kind of spike in Omicron variant, but largely, if you look at it vis-a-vis the rest of the world, there is no part of the world that is kind of immune to corona. That's been the feature. So it's been it's like one-eyed person is the king in a land where everybody is blind. So that's how the global economy today appears. And thankfully, India appears in a better place than many of the regions in the world. So we at least have large portions of our country working now, whereas Europe and many parts of the rest of the world continue to have significant lockdowns happening and impacting the way of life, which is quite sad, but that's the reality, my friends. So over the last 2 years, for the first time in probably 100 years, we saw all the global economies decelerate. Normally global economies grow at about 2.5% on the whole. But 2020, everybody grew negative 3.1, the global economic average by IMF standards. And then the advanced economy grew much more, and the emerging markets did less. But in 2021, everybody bounced back. Everybody bounced back significantly. And the reason was two things. One is 2021, everybody realized that, later part of 2020 and early part of 2021, everybody realized that COVID, while it is bad and it is dangerous, can be overcome. And so many economies took very, very dramatic steps, including our own countries, took steps to ensure that the vaccination drive took off. And, we took this lockdowns very, very seriously and made sure that the spread of COVID was kind of limited in that sense. Of course, there were human tragic costs, but we couldn't have done better than what we did, is my opinion. And sum and substance is that because of this and because of the fact that global markets, globally, I mean, I'm talking about US, Europe, India, everybody, the governments pushed money out because they realized that the economy is going through pain. They pushed a lot of money out. So The amount of money supply that existed pre-COVID to post-COVID is almost 1:3. Pre-COVID 1, post-COVID is 3, because that much amount of money has been pumped into the market to ensure that the economies continue to have the firepower to withstand the COVID onslaught. So typically you found that 2021, the markets came back pretty sharply because of the COVID related, kind of funding, and so many other measures was done. Except, of course, few sectors continue to suffer. Travel, tourism, and many of those sectors continue to bear the brunt. But by and large, the rest of the economy seem to have kind of bounced back pretty sharply. The expectation as we speak now is that 2022 will be a lesser year than 2021, because 2021, remember, came from a very low base. We had a negative return and then we went up. 2022, we are not going to have that benefit. So we're continuing to grow, but we're going to grow at a slightly lesser pace than 2021, but it's still going to build on the momentum. We're seeing that sense. The global, the India business confidence is at a reasonable high after having touched a low during COVID, and it's kind of rapidly going up. And month on month, the GST collections, as reported by the government, is also pretty healthy. So right from a low base prior to COVID, we are now reaching about 130 to 150,000 rupees crores, 150,000 crores, which is a reasonably good number for us to kind of build on. And the expectation is that this may not change significantly going forward. The e-way bill generation, which is a process that happens 1 or 2 months before the actual GST commitment is made, is also on the rise. So giving a sense that we are finally at a point where we have put COVID behind us, and manufacturing activity and service activities have started to kind of move up significantly. So all this gives a confidence that maybe we are finally out of the COVID problems, and the economy is here to stay in terms of the growth in the economy, which is what will kind of lead to a every aspect, the stock market to everything else depends on the economic progress. So to that extent, I think we are finally getting to a point where we're going to be Of course, it's extremely important to look at the economy, but the outcomes are also kind of quite interesting. 2021-22, the financial year, 2022-21-22 promises to be one of the biggest from a stock market perspective. The number of companies that are raising money is unprecedented, my friends. We're probably going to see roughly about 2.3 to 2.5 lakh crores being raised during this period. This is unprecedented. We've not had such a year any time in the past, at least in the near term. The last time I can think of such a euphoria was way back in 2001, 2003 kind of period. But this is quite unprecedented. I won't say that this is great. A large part of this is happening because of two reasons. One is, like I mentioned, there is a large supply of money that's happened. Government has pumped in, both global governments have pumped in, Indian governments have pumped in. So there is a lot of money available in the system. So that's kind of finding its way to the stock market. Second is, interest rates are at a record low. So as far as savings are concerned, when people go to the bank, they find that the bank deposits don't even cover inflation. So they are looking at ways to kind of generate returns, and a booming stock market is one of the ways that people are finding their need to invest. So these are two things. We will discuss in the Q&A whether this is the right approach or wrong. I'm not here to make a judgment call, but the stock market is at an all-time high, and the IPO market, the new public issue market, is at an unprecedented high as well. Like Mr. Gopi was saying earlier when he was introducing today's talk, e-commerce has grown quite significantly ever since. One of the positives if I may say, of COVID has been the emergence of e-commerce. So every individual, be it a youth to a middle-aged to an elder person, today has at least one touch point on e-commerce that happens. Either they're buying stuff on Amazon or on NetMeds or on something of the other. So e-commerce is really kind of got to fill up significantly during these COVID times and doesn't look like it's going to go back in some significant way. So we are seeing, we're also seeing a lot of those companies now come out into the stock market, which is also a sign that they internally believe that their time to make profits is near. So it's the way the digitalization is happening at a much faster pace than what we would have imagined. I'm going to kind of quickly digress into what is about the economy and the markets in the last few years and months. So just to give things in perspective, the market return over the last 10 years from 2011 to 2021, if you look at it over a 10-year span, it's still only 10%. Right? It's not, people get this great feeling that, we've had a fantastic stock market last year. Absolutely, we've had a fantastic stock market. But remember, 2015, 16 onwards to almost 20, we've had a reasonably poor stock market. We've had a reasonably difficult economic change. We've had a demonetization that really crippled the country. Then we had a GST which was implemented, and it took a fair amount of pain for the industry to adopt GST and kind of move ahead. You had a variety of new regulations, the insolvency bankruptcy code, the RERA in real estate, you name it. We had a variety of different legislation that were implemented during the period from 2016 to 2020, the 5-year period. And a lot of that left industry in a very unsettled manner. If you do one legislation every 3 years, then you have time to catch up. But if you do 10 legislations in 5 years, then industry doesn't know what to do. It's kind of trying to catch up with what's happening. So that's exactly what happened in India. So the stock market on a 10-year basis hasn't kind of really done great. I mean, it's okay. It's not great. From an emerging market sense, people expect that the stock market would have generated much higher returns. Obviously, the returns are now coming, and now coming because there's also ample liquidity in the system, like I mentioned. So that's also one of the factors that driving the market. So one of the things is, we always often hear this argument, India, China, India, China. Many people talk about India, China. Friends, my own view is, China is way, way ahead. We are no comparison to China. We may want to compare ourselves with China, but we are not there yet in a big way, significant way. So if you look at 2010 to 2020, in the 10 years, China moved from a GDP of 6 trillion to 13 trillion, doubled its GDP and more. And India moved to 2.6 trillion, somewhere in 2020. So we are a long way. We are 2.6, China is 13. So roughly about 5-6 times. China's GDP is 6 times of India. There are 6. It will take 6 Indias to be what China is today. So that's really the thing. So China is way ahead, but I think the positive is that from a growth rate perspective, going forward, most experts globally have a consensus that India's growth rate will be better than China's. So between 2021 to 2030, India is likely to grow at a much faster pace than China will ever be able to grow. So that's a very, very positive of what we expect to do. And one of the view that the world is looking at is that over the last decade, China has been a global consumer. China consumed almost 30-40% of global steel, 30-40% of global cement, so on and so forth. They produced a lot, but they also consumed a lot. The whole world is looking at India and saying, hey, is India going to be the next China? Are we going to consume that kind of resources in the next, say, 10 years? And that's really an interesting proposition. And India is where China was in 2006. So in the next 15 years, if we did what China does, we'll be pretty substantially in a different place to where we are today. I love this slide because this epitomizes the point where India today is. You know, it took 58 years since independence for India to reach its first $1 trillion of economy. You know, the GDP is measured in the form of dollar terms so that all of it is comparable. So it took India almost 2008 to reach its first $1 trillion, right? Guess what? The second trillion happened in 7 years. So you are engineers and you know geometric progressions. So many of these are following the geometric progression route. 58 years for first, but 7 years for the second. Actually, the third trillion should have happened already. Unfortunately, like I mentioned, the 2016 to 2020 was a period where India went into the garage and kind of had to be kind of, you know, there was a massive repairs that were going on. And because of which the third $1 trillion has got delayed a bit. So we are kind of seeing that the third $1 trillion will take any time now, and so on and so forth. So the government is pushing for a $5 trillion economy. I mean, I'm sure we've all heard that that the government's focus is on a $5 trillion economy. Our expectation is it will happen anywhere between 2027 to 2029, depending on how India grows from here. But it's a significant movement for a country that saw its first $1 trillion happen only in 2008. So it's this power of compounding that happens in investing is also working for the economy, so to say. So every $1 trillion is happening at a much kind of faster pace, so that post 2032, one of the economists that I was talking to said India will probably add about $1 trillion every year or every 9 months, which is fantastic. That's when the economy really catches on and moves ahead at a much faster pace. Now, why is growth important? Why is GDP important? This slide gives you a basic sense. You know, at a GDP of 1,000, 600 rupees, 600 out of the 1,000 goes towards our basic spend. You know, our basic requirements for life, livelihood is within that 600. And then 100 rupees towards basic discretionary spending. And then savings goes to about 300. That's how today a vast of India, the average of India is today in this space. Now, assuming that we hit this $5 trillion mark, our GDP is expected to be something like 3,000. Now, when it is 3,000, if you look at that next slide, 600 of your basic needs doesn't go because your economy is doing well and you're doing well. You don't eat more because if I'm used to a diet of 2 idlis and 1 vada for breakfast, I don't necessarily make it 10 idlis and 2 vadas because I'm economically better off. So that kind of remains where it is. Where that changes is that big 10x change happens in discretionary spending. I will eat more out. I will travel more often. I will go to a fine dining restaurant. I will fly more often. I will do more holidays. I will buy more luxury goods. All of it is the discretionary spending. And this is where China has been the major beneficiary over the last 15 years. If you go to China and you look at those big branded stores, they have done a phenomenal job because the average Chinese today buys only branded stuff. And that's kind of led to a consumer boom in a big way. So we are expecting that we will also follow suit in some sense. So in a nutshell, from an India standpoint, India is the ultimate $1 trillion opportunity for the globe currently. We are at a very, very good place. We have a great democracy going for us. Demography, which means the population of younger people. You know, 85% of India's population is below the age of 50, which is a phenomenal advantage that India is facing. No other country of the size and scale of India has this advantage currently. So it's a great advantage because why is this an advantage? Below 50, everybody consumes. Everybody wants a bike, car, house, wants to travel, wants to eat out. So it's a consuming age. So that's going to be greatly favorable. Of course, digitization. In UPI, the Indian payment system is one of the most advanced one today in the world, including United States. So if you talk about UPI, the payment network that we operate on, it is second to none. In fact, United States is now looking at, taking tips out of the market and digitization, and how India has adopted digitization, especially the universal payment interface, UPI, that we have used, is something that US is looking to adopt at this point in time, because US has always favored a private sector network. So Visa and MasterCard are the preferred norm there, whereas India has chosen to go with a domestic network as well. So, and we are sitting on record dollar reserves. Just to give you a sense, in 1991, when Narasimha Rao opened the government, opened the economy to, opened up the economy because we had our backs to the wall, our reserves was less than $5 billion. We had $5 billion, and that would have covered about 2.5 months of purchases at that point in time. Today, our reserves, our dollar reserves are upwards of $650 billion. We are at a vastly different place today, and reasonably stable government. Of course, COVID is a big, like I said, a black swan event. But I think India has been able to manage COVID in a reasonably good manner with record vaccination. We still have a long way to go, but I think COVID is largely behind us, unless this Omicron throws up a dramatic surprise to India, which as we speak doesn't appear so. So Sensex, if all goes well, and if it does what it's been doing, expectation is by 2030, Sensex will be 4 times where we are. We are somewhere around 55,000 on the Sensex today. Expectation is in 10 years time, we can be, and I'm not trying to give you a number there, but we can be somewhere around 2 lakhs at a compounded growth of about 15%, which is entirely possible. Lots of value bets happening on private banks, life insurances, a whole scheme of things are happening in terms of migration into better value. So my urge to people is that finally India will get its time under the sun, but it's important to be very optimistic and be patient. Nothing happens overnight in India, but as long as one is optimistic and patient, I do see a great future for India. Now, friends, this is about the macroeconomic conditions, the global economy and the macroeconomy that I've spoken about so far. These are great stuff, but these alone are not good enough, right? Having a great global or macroeconomy is great, but how does that add to my pocket, right? To have a profitable investment, there are some things that we as investors need to adopt. And I'm going to briefly cover some thoughts of mine. One of the ways that I have seen great focus and discipline come is when we all put a goal-based approach to investing. Instead of investing just for the sake of investing, if we invest to achieve a certain goal, that I find it very objective. It brings a great objectivity to investing. That I think is a huge advantage. And that's an important aspect of how one can be very objective about investing and be very clear about reaching certain milestones. So I would urge investors to look at goals. What are your goals? I mean, if you want to set up a set of money, or you want your money to grow from point A to point B, define those goals. Make sure that you're comfortable with the kind of numbers that are there, and work very objectively with making that happen. So goal-based approach to investing is one of the secrets to which one can achieve. Like I mentioned in the GDP argument, we seldom look at compounding as the basis, especially if you have a period beyond 5 and 10 years, then power of compounding is pretty significant. And I'd urge you to consider that, because we're constantly looking at the near term. You know, as markets fall and as markets go up, if we can kind of hide the noise between the short term and really look at the long term, I think there is enough and more money to be made. One of the simple examples of how power of compounding works is to look at the Warren Buffett story, right? Warren Buffett, we all know, is the world's richest man, but he started his journey to be an investor around the age of 11 or 12 years. His first investments were made in about 11 or 12 years. But it wasn't until his age of 59 years when he hit his first $1 billion, right? So it took him the same journey like India did. It takes that long to create your first $1 billion, right? Now he's probably worth about 90 billion or 100 billion dollars. So the next 30 years, that 1 billion became 90 billion. So really the power of compounding is to allow you the time to make those things. If you don't have patience, it becomes difficult to allow investments to play their role. Constantly toying with investment doesn't necessarily lead to an advantage. Like I mentioned, investment is not about investing, it's about managing risks. Extremely important to look at this because sometimes we all get carried away, my friends. I mean, I'm one among you, so I too get carried away with what's happening around. So, but if you're constantly one part of your brain keeps looking at risks and managing risks, then you can avoid those pitfalls in a broad sense. So that's what I wanted to kind of leave. One of the mentors that I had told me a very important and interesting lesson. He said the most objective decisions humans will ever make will have about 50% emotion in it and 50% rational. Now imagine if you didn't use the most rational, then you're using 90% emotion. And emotions are bad for investments. So be it a fear or greed, both are bad, but emotion generally is very, very poor. As investors, we need to be conscious that we are making investment decisions or we are making those investment ideas when we are not emotionally, kind of affected. We must have a clear mind and we must have a clear thought. There are lots of times I notice that people make decisions which are emotionally linked and they tend to be very, very poor and be hindsight. So one more pointer is to not, investing is difficult enough. Adding the emotional layer is even more difficult. So that's what I wanted to think. Last but not the least is I often find people getting obsessed with money. I am an investment advisor. I spend roughly about 10 to 12 hours a day on money and money related issues. But I'm very conscious at the end of the day is money is only the means. If I was left in an island with only money, I would still starve to death because I still need fruits and food and so on and so forth. So it's extremely important not to get obsessed with money. Money is important. We need to plan, we need to invest. But obsession with money is something that's very, very unhealthy. Today, I'm finding a lot of youngsters constantly obsessed with money, right? And I think that's not the right way to go about things. So I'm going to kind of stop with these human behavior traits that I think is important and then move to some of the different investing products. I'm going to be pretty rapid. I need to cover this in the next, say, 15, 20 minutes in all. So I'm going to kind of go through this, and some of this you'll be familiar. These are more to provoke your ideas and thoughts, and we can have a more detailed discussions in the Q&A. With that, I'm going to kind of proceed to, for the purpose of today's discussion, I am only going to talk about liquid investments. I mean, I am not an expert when it comes to real estate. That's not my forte. So I'm not going to dwell on that. These are more about liquid investments. And these are the things that we are going to largely see over the next few slides. So one is we're going to look at equity investing, which is both private and public investing space. We're going to look at gold. We're looking at debt. Debt is nothing but a bank deposit kind of a product. And then we're going to look at some digital and some overseas. And I'm going to be brief about my thoughts. We will have more elaborate, more specific discussions, which you may have questions on. So first up, equity. So like I said, equities can be private and public. Private investing is nothing but angel investing, venture capital funds, and so on and so forth. These are very, very high risk investments, not suited for everybody. Very, very few people, the very rich people who have a large disposable money can be party to this. They make investments here. One of the rules, one of the tenets of angel investing is that if you make 10 angel investments, only 2 will give you returns. But the 2 should give you returns enough to cover the loss of the other 8, which will go down. So these are very, very high risk investments. But when they come true, they give you phenomenal returns. So that's angel investing. Venture funds are a category of a much more advanced than angel. When the new venture or the startups get to a certain more mature point, we get into venture funds. And of course, the last but not the least is unlisted companies. Sorry. Unlisted companies. These are also companies that are just before they are listed in the stock market come out. Again, a certain amount of risk. And because you assume that certain amount of risk, the payoff is that the returns are also reasonably higher. Of course, the public markets are always open. The good part about public markets is that they are always liquid, my friends. So one of the things is, even at the height of COVID, when the stock market dropped by almost 30-35%, the stock market never closed even for a single day, which is huge. So if you wanted liquidity and if you wanted money, equity markets have always delivered and always kind of stayed there for investors at the quickest possible time. So the public markets are shares, stocks, then exchange traded funds, mutual funds, different thematic funds, and so on and so forth. So broadly, you can buy it through shares, you can buy it as an exchange traded funds, or you can buy mutual funds. So all these options are available for investors to look at equity. Why must investors invest in equity? The bank deposit continues to be a reasonably low rate today. And because inflation continues at a certain base, if somebody wants to make an alpha over their bank deposit, then they need to assume a certain risk. And that's where equity comes in. So equity is, thanks to products like mutual funds, has become a very retail product. And of course, stocks also have become very retail. It has both its pluses and minuses. I'm not saying it's bad, but one needs to be conscious about the fact that one is willing to take that risk. And it has some inherent risk in it. So like I already mentioned, public investing is about equity shares, exchange traded funds, and mutual funds. And one can buy depending on what one is needed. The way I look at equity shares are buying equity stocks with a 3 to 5 year horizon at the minimum. Now, I am a buy and hold investor. I don't understand too much about speculation. I don't understand too much about futures and options. So I prefer to put my cash down, stay invested, buy something that I see value in. And if I can wait for 5 years, then I believe one can kind of make a return somewhere around 15 to 20%. Of course, none of this is guaranteed. So one needs to be careful about making these calls. One of the key traits of this is that if what you buy at 100 rupees becomes 50 rupees, you must be prepared to hold on to it. You must stay invested in it for you to see value at the end of the day. So it will be up and down, but you must be willing to kind of stay with this. Exchange traded funds are another interesting category. If you don't know or don't have the time to kind of individually do analysis on the stocks, then you can go into the market, stock market, and buy what is called ETFs, exchange traded funds. Exchange traded funds are nothing but a bunch of companies bought by a fund and held in it. So you will get the weighted average of the performance of those companies within that fund. A very smart way, if you don't have fundamental knowledge of those companies, if you didn't want, then this is a This is a good way to kind of pick up low cost, quick returns, quick way to kind of invest your money. Again, you will need to look at a 3-5 year horizon. I'd say 10 to 12% per annum compounded return is something that is entirely possible by getting into ETFs. Again, ETF is nothing but you're investing into stocks, but you're investing into a bunch of stocks which are created as a fund. So that's what you need to look at. So if you want your money to be managed by a fund manager and who can add tremendous value, then you need to get into equity mutual funds. Again, the time horizon is 3 to 5 years. What the fund manager does is he collects investments from multiple people like you and me, and then creates a portfolio and manages that portfolio. Again, as long as you're willing to wait for a 3 to 5 years, you should see superlative return comes to you. But like I mentioned earlier, there will be times when your investments will be below water. If you've invested 100, it will be at 70. So you should not be somebody who panics at that and kind of tries to pull out. You must continue to stay invested. Or if you believe the fund is good, you must buy more when it is 70. It's difficult, I know, easy to say, difficult to do, but that's really the magic that equity investing can do. There are various categories within funds. So there's a large cap fund, which comprises the top 100 companies. There's a mid cap, which consists of the 101st company to 250 companies. And then the small cap, which is 251 to 500 companies. Then there are sectors and theme funds, pharma sector, IT sector, so on and so forth. So a variety of different themes, different funds, according to what you want. It's like, go to an ice cream shop, there are hundreds of flavors. It's up to you to pick up what flavor you want. Different flavors taste differently, have different risks and different return parameters. So it's up to the investor to pick up. Like I said, private equity is really for those people who have spare money, which can be kind of lost without too much of anxiety. So these are angel investors, venture funds, and unlisted companies. So I have the set of money, and routinely investors do have. Many of the people who have raised money and started up, when they raise additional rounds of funding, they have liquid cash with them. They turn into angel investors and invest into other ventures that other people are doing. So that's how the angel investing route comes. It's also open to investors. Typically at a much larger size. Like I said, you must have a clear 5 to 7 years or even 10-year horizon for angel investing to make money. You must have a very, very clear, conscious mind that you don't have a problem if you lose money in a couple of those ventures, as long overall you make money. It is a difficult game to play. And venture funds are even more riskier. The ticket size for a minimum venture fund is about 1 crore as per SEBI mandate. So you need to look at, funds. You need to look at putting away 1 crore. And our bet is if your total portfolio is not close to about 7 to 10 crores, you shouldn't be getting into these kind of investments as well. So of course, there are unlisted companies which are now getting popular. Again, a huge risk. One needs to be very careful about parking monies in this. It's not necessary that everybody will make money. What typically happens is those few cases which have made money constantly keep getting talked about. 90% of the cases, it's like your Rajinikanth, right? One Rajinikanth who was a bus driver, became a superstar, gets talked about 1 million times. There are 1 million bus drivers who remain bus drivers who don't get spoken about. So that's an important parameter that we need to remember, that what gets spoken about is not necessarily the reality. I'm going to talk a bit about debt. Debt is an important class. It's your FD. It's your plain simple, at the simplest version, it's your fixed deposit in the bank. Given that the rates are low, many people have this tendency to go into more risk, all of it. My suggestion is there is a role for debt to play, because these are meant for any emergency or any needs that you may have. So a certain set of your money must always be in places which are easily accessible. And debt is a beautiful place for that. There are bonds and debentures, taxable, tax-free bonds. There are investment trusts. We call this REITs, real estate investment trusts, which are newly come in the last few years. These are good products to explore for investors over long term. And of course, mutual funds, just as they invest in equity, they also invest in debt instruments. Lower risk, but lower also is the return. So these are all options that are available for retail investors to explore. Some of them are really, really good. Like I mentioned, bonds and debentures. I'm going to go a little bit quicker in these. We can have specific questions in the Q&A, because otherwise it will seem like a classroom session. So like I said, today in debt, one can start with 1 day, which is the liquid fund kind of an option, to go on till 10 years, which is a government securities or a gilt fund. So depending on one's timeline and one's risk appetite, one can go right across. What I've given is very indicative. It's not necessarily the same, but you can invest it depending on your risk appetite and the duration that you would like to stay invested over long periods of time. So these are all the options that are available for investors to look at. The third investment option is gold. In some sense, gold is an alternative to equity markets. So for some reason, if equity takes a dive downwards, gold tends to go up. It kind of has a counter to equity returns. So we believe a small investment in gold is a good thing for most investors to kind of keep. And gold can be bought in multiple ways. You can buy exchange traded funds. There are funds that are listed in the stock exchange. You can buy those gold funds. What those gold funds will do is they'll collect money from you and they will buy equivalent gold and keep it in a safe, just as you would have done. The only advantage for you is you can go to the market at any given point in time and liquidate your gold holdings, and you'll get the money in the next day. Whereas if you held to physical gold, you would have to go and transact on it, and you'll have to sell it, and it takes time and energy and effort, and there is a loss in transit and loss of sale and so on and so forth. So all that gets avoided. It's completely held in the paper form, but you realize the value of gold. So that is ETFs. Similarly, in the index funds, which is a mutual fund which invests in gold, that also is the thing. The third one is government of late has been promoting this government sovereign bond, sovereign gold bond. Now, one of the rationale for this is very simple, friends. India imports roughly about 99% of its gold requirement is imported from abroad. We don't have domestic gold either discovered or kind of found in some form or fashion. So 99% of India's gold is imported, and India is a large gold market. So to that extent, there is a precious foreign currency that goes out of the country every time. So government launched the sovereign bond to make sure that the gold that is locally available gets used for these purposes. So the government buys the local gold and issues the sovereign bond, and these bonds generate about 2.5% interest for the holder. And at the end of 7 years, the gold price as on that day is returned to the investor. So it is a way in which government tries to monetize the existing unused gold so that it can prevent forex going out of the country. So it's a good scheme, but one needs to bear in mind that one stays locked in for a 7-year period, and that's a long period. And the rate of return that gets in that somebody gets in between is just 2.5%, and that 2.5% is also taxable. So in that sense, it's not so great, but it's a scheme that's helped many of the large trusts, especially the religious charities, make good returns. Especially people like Tirupati kind of do a lot in these bonds because they get a sizable chunk of their money in the form of gold and gold products, and they've been able to use these schemes pretty effectively. So it's worked in that sense. Retail is still low, but it's kind of catching up. Friends, I'm going to briefly talk about digital. Digital is a future. Let's understand this. That's my view. It is going to be risky. It is not something that I would recommend all. But the fundamental, at a very, very fundamental level, one needs to understand why cryptocurrency came into existence. We believe that the currency is to exchange. I give 100 rupees and I buy something back. It's a medium of exchange. It's a medium of storage. That's how currencies came to be. But over the last 100 plus years, we've also seen that currency is no longer just a currency. It's become a political tool. And that's been the case in the last 50, 60 years. Some sense that's not a good sign. People use currency, countries use currency today for their political needs. So cryptocurrency is a way of neutralizing that politicization of currency. And that's how it came about. And because it came in that form of fashion, I believe cryptocurrency has a great future because it tends to neutralize the political advantage that somebody is trying to score a political point using currency, and which should not be the case. I think cryptos have a future. Long way to go. Crypto has its benefits. It's a very safe, secure currency in that sense. In fact, it's safer than your rupee, if you ask me from a digital standpoint. But it's still some time before it gets to be stable. One of the negatives of cryptocurrency is that it's very volatile. You see, $10,000 Bitcoin going to $50,000, rapid rise, and then next day it goes down to 30,000. So it's very volatile. So to that extent, it may not necessarily be the currency at this point in time for most of us, because we can't digest that kind of volatility. So we'll have to wait and see how this space evolves. So at this point in time, I'm not recommending, or I'm not invested into any of these cryptocurrencies, but I continue to believe the logic behind why crypto came, and also the fundamental technology behind which crypto is, I think they are very sound. And I think there is a future available. When that future will unveil, I have no idea, but I'm hopeful of this. NFTs are products on the digital world which are traded. They're called non-fungible tokens. That's again a digital asset which many of the Indian film stars have taken to, and so on. So for the early days, yet again there. I just wanted to kind of bring this. We can also discuss. I have limited knowledge, but whatever I have, I can share it with you in the Q&A. One of the ways in which Indians are diversifying investments now is also by investing abroad. So today you have government allows you to invest 250,000 US dollar per year per person. So a family of 4 can invest $1 million abroad. And one of the reasons why we need to look at this is that we need a currency arbitrage against Indian currency. Indian currency is depreciating vis-a-vis the dollar at the rate of 5%. So we need to move currency into some other currency where it doesn't depreciate to that extent. It's an investment which we need to diversify. And to a certain extent, investing abroad gives you that advantage of diversification. So there are various ways to do this. And that's been slowly catching up over the last few years, investing in overseas securities and so on. And this is one more way Indian investors have been participating to diversify their investments more than returns alone. So friends, I'm at the last part of my presentation. I'm going to talk a bit about what I think are the key themes that will play out in the next 10 years in this decade of 21 to 30. And these are purely my thought. Happy to kind of be, kind of differ. Please feel free to differ with me. I think the threats that I see for India, particularly in the next few years, is the biggest enemy for India is India. If we can have domestic politics out of the window and really focus on economic growth of the country, I think we'll have a great story. But I do believe there is a domestic politics that will play, and India is a game. India is a nation of politics. So politics can kind of be detrimental if political leaders don't take the higher ground and play low politics. It can be a significant threat. And of course, like I mentioned, global politics also plays a role. How things pan out. Typically, countries get made or destroyed thanks to global policies as well. So Global politics is one more thing that can threaten us. At this point in time, we are on the positive side because the globe is against China. A lot of things are happening for us, but things can change very dramatically for us, against us also. So it does remain a credible threat. While India is doing fantastically well from an emerging market sense, we're not alone. Countries like Vietnam, Cambodia, Indonesia are very close to us. They are almost following suit, except IT, where I think we have a significant advantage to all these countries. On manufacturing side and many other sides, these countries are really, really right up there. Vietnam and Cambodia have among the most committed workforce that you can find. So in fact, many of the global majors believe that Vietnam or Cambodia could be a better alternative to India, except that India also has a vast consuming population. So if I manufacture in India, I also have the advantage that I can sell it to Indians, which is much smaller in Vietnam and Cambodia, but definitely they are big, big competitors. And of course, global factors like crude oil, we are still dependent. 98% of our fuel requirements is imported. We buy it from Saudi Arabia and so many other countries. So for the near term, crude prices, we're dependent on crude prices, and crude prices can really throw us off ground. If crude goes $120, we will, as an economy, struggle and suffer. If crude goes down to $50 a barrel, as an economy, we'll celebrate. So really, we are dependent on an external source. So to that extent, there is a threat there. And of course, things like COVID's resurgence, Omicron, and so on and so forth does present a threat. The opportunity is China plus one. Really, the whole world is rooting against China, and one of the poster boys is India. So the China plus one story is really pushing and is expected to push a lot of business to India. So we are going to be beneficiaries thanks to the hate that China is drawing, thanks to a variety of things that's doing, both on geopolitics as well as on COVID-related measures and so on. And of course, India has been, like I mentioned, 2016 to 2020, we had a series of things that we did. We did this IBC, insolvency code. We did this GST. A lot of that payback is just starting to happen. And I believe the payback will be huge in due course of time. So I do believe these are great opportunities for India and Indians at large to grab. So I am very, very hopeful and positive that the next decade will be huge for India and for investments that are based on that economy. So I do remain very, very hopeful that we as Indians will benefit out of that. Helping you reach the peak is what FinSherpa is all about. From a standpoint, as an organization, we help with a variety of different personal interventions for our investors. And I am open to questions, my friend. I am slightly over time, I'm sorry, but I thought I should leave you with all this message so that we can then carry it forward. I will pause here. I love to hear my own voice, but I'm going to stop here and I will throw it open for any questions. Thank you so much.
Thank you, Babu. Excellent session. The perspectives were really refreshing. We had a lot of takeaways. So I'll just keep the floor open for questions now.
Sure.
Yeah, Mr. Babu, it's a very good overall view, and I think it's limited time. Thanks a lot. This is Dhanshekaran. Okay.
Sure.
By the way, my point is, what is your experience on multi-baggers?
So I'm not much into stock, Mr. Dhanshekaran, but multi-baggers will continue to happen. So every decade, you see these stories of multi-baggers that keeps happening, right? So two things define how one can benefit out of that. One is you must have a deep insight about that company or that industry and how this is panning out. That's important. And you must have substantial amount of investments riding on that, right? So let's say, for instance, Infosys is a multi-bagger that happened in the 90s, right? Then in the 2000s, you had pharma companies like Divi Labs and so on and so forth. So every decade, you will have these big companies that become multi-baggers. Now, if you bought 100 Infosys, you made money, but you didn't make significant. You didn't make life-changing returns. Right? So really the point is that you must identify these multi-baggers, and then you must kind of put a lot of your personal wealth into that space, so that when that real, multi-return happens, it's a big, game changer for your wealth. That's difficult, that's risky, that's not for most people. But I as a philosophy, I prescribe more diversification. So as a result, I have not seen or I have not encountered multi-baggers from a stock perspective. My multi-baggers have happened more by staying invested for a reasonably long period of time. So there are two ways to make returns. One return is to find that elusive stock which can give you a phenomenal return in a certain period of time. Or the other is to buy a basket of securities through a mutual fund or index fund, and then stay for a 20-year period when you will still make that multi-bagger. So I've been more on the second than the first. So unfortunately, I'm unable to kind of give you any specific hints or about the former. Does that answer your question, Mr. Danshik?
Yeah, thank you very much. Okay, it's a very good angle of mitigating the risk. My another question is, last but one slide, I saw something like DMON. I think I didn't see it properly, that slide.
No, so I mentioned, so so we all, demonetization was the word that I was trying.
Oh, okay.
While we all know demonetization was hugely negative and blah, 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 one of the positive is that today, the digitalization has really caught on thanks to demonetization. So there is a positive for every negative. That's what my context was.
Okay, one more last question. During this pandemonium, the shares index dropped heavily. Okay, so you simply stayed, or you try to exit at the right point and then re-enter at the right place, which is very difficult. Okay, please.
So one of the views that I hold, Mr. Dhanshekhar, is that if you have invested in fundamentally good funds or stocks or whatever be that, you cannot identify these black swan events, as we call them. COVID is a black swan event, right? So 99% of both my own personal wealth as well as my investors' wealth were in the markets when the market fell by 38-40%. Now, there are two questions that you need to ask yourself. One is, of course, the value of my portfolio is down. And if that value is a couple of crores, then it's very worrying and sometimes very unsettling as well. Two things. One is all that money needed by me in the next, say, 6 months, 1 year, 2 years? Right? That's a question I need to ask myself. And in 90% of the cases, the answer was no, I don't need all the money. I may need some portion of the money for my lifestyle, but other than that, the entire money I don't need in the next, say, 18 months time. So none of us needed to access the money. Second is this your own story or is this a global phenomenon? That's another question that you need to answer. Did the stock market or did only your stocks fell, or did this happen across the world? Now, if it was only your stocks, then I'd be very worried. If it was only my stocks that fell by 35-40%, then I'm very, very worried, because I know that I may have picked the wrong stock or something else dramatic may have. But if the phenomenon is global, then I'm not alone. The globe will find a way to fix this. And as long as I give it time, and this time it took much faster, but normally my sense is you need to give it about 12 months to 18 months for things to react and be back in some form or fashion. So as long as you give that, it kind of is reasonably bounces back. So that's my thought. I mean, believe me, I was like any of y'all, my stock also fell. I also had that strange feeling in the stomach, whether, am I going to go bust with this? But then slowly you kind of watch and wait and watch. So one of the secret to investing in some of these, especially equity assets, is the game called patience. You need to be patient, and it's a skill that is not easy, but that's one of the skills that I have learned to acquire over periods of time. Be patient and do nothing.
Thank you. Thank you very much.
So my name is Pratap.
Yes, Mr. Pratap.
Yeah, I'm from 2001 Chemical. So it was a very good presentation about various investment options. My question is, what are the trends which are going to evolve? What are the mega trends? Should we align our investments in line with those trends? So what are your foresight, for the coming years?
Good question, Pratap. Good that you raised this, because I didn't cover this in my presentation. A couple of big trends have emerged, especially post-COVID. Some big trends have emerged. And the first trend is what I would name as ESG. There is a trend called ESG. It stands for environmental, social, and governance. So what's happening is globally, the large big funds are channelizing funds into companies based on this trend, which we call ESG. Is the company that I'm investing money into, is it environmentally conscious? Is it environmentally friendly? Is it doing something good, or is it making sure it's not doing something damaging to the environment? That's a question investors are asking. It's also asking from a governance perspective, is it a company that offers equal opportunities? Are there enough women on board? Does the board have enough women? Does it have any policies that are for the people? So on and so forth. Those are difficult conversations that are happening there. Last but not the least, these are funds which are asking questions on social. So how is this company benefiting the country, the economy, so on and so forth? So what is happening is, if there are companies that are doing well on all these parameters, more monies tend to chase these companies. So as a result, you would find that these companies, stock prices are better, their kind of valuations are better, so on and so forth. On the contrary, if the company is doing something that is poor on the ESG terms, then investors tend to dump those stocks. And as a result, even though it could be a profitable company, it doesn't enjoy a great future. This came about because people became more environmentally friendly. And in some sense, the global feeling is COVID is not something that hit us out of nowhere. It's a rebound of what we did to nature, right? So we did something bad to nature, and nature came back and hit us back with COVID. If you don't want multiple COVIDs to come back in the decades ahead, then we need to be conscious. So ESG is an important theme. The clean energy is an important theme. EV related, the electric vehicle related theme is an important theme. The digitalization is an important theme. So if you ask me three themes, I'd say ESG, EV, and digital. These are three themes that are going to drive the next 10 years for me. I mean, that's my opinion.
Yes, I am pointing to one point, sir, that all that multilateral fundings, World Bank and Asian Development Bank and JICA, they are insisting for more environmental and social concept. They are given the provision for some percentage to meet the environmental and social requirements. I am working for some environmental side for the World Bank Asian product projects. They are keen on the environmental social. Once they have to complete all the environmental social requirements, then only they give the funding.
Exactly.
And also Asian Development Bank, they are now focusing on the sustainable development for that. They are not investing for the petroleum product. So going for green and other product, they are willing to finance.
Absolutely.
Thank you.
Thank you, sir. Thank you.
Mr. Babu, this is Shanmuham here. One of the things, nice insights to the investments aspects. One of the things that you mentioned and that you said you learned yourself as well was the term called patience, right? Now, in today's scenario, the millennials, as they call, I don't think that exists with them, the patience factor. So what would your insights or advice be to those kind of people who look at things to happen right from the time they invest to tomorrow, that they would want something on their hand? That's the kind of mindset I think the millennials have. And what would your advice be?
So difficult. I completely agree with you. I don't understand how the millennials work. My own nephew and nieces are very different from the way. So I advise the entire world except my own family. My nephews and nieces don't listen to me. But having said that, I think they are a bunch of bright people. I mean, it would be wrong to write them off saying that if you don't follow my methodology, you're not going to make money. No, I think they are going to be smart as well. They're going to do stuff differently. Yes, you're right in terms of saying that they may not fit the conventional wisdom of investing regularly or investing in the long term, so on and so forth. In fact, their own long term itself is a 3-year period, right? So my long term is 10 years and their long term is 3 years. So everything is changed in that sense. It is going to be different. It's going to be difficult. If you ask me one simple answer, how this is going to be, I don't know. But one of the things which I have kind of tried to experiment, like Mr. Gopi, so I'm involved with a fintech run by a millennial called Roundups. And what we are seeing is that they're reasonably smart as well. And we have created a Roundups. And Roundups, very simply, just to add to that, is a concept that in my generation, or even for that matter, in your generation, saving was a conscious effort. We saved money consciously. We wanted to save money because that was the way we were told and taught. Whereas millennials are going to save money very unconsciously. And this Roundups, for example, does that. Is that if they go to a coffee shop and have a coffee worth 150 rupees, the app, if they have this app, the app will urge them to round it off. And they can round it off by a 50 rupees. So for them, the spending will appear as a 200 rupees, 150 towards coffee, and the 50 rupees will go towards the savings. So there are multiple tools like these that are getting developed. And we are not the only people. I mean, there are a bunch of people who are doing similar stuff, where this money gets saved very unconsciously. And also, the purpose of saving has also changed, right? I mean, I come from a middle-class family. If I didn't save and if I didn't make money, I didn't have a great future. And it was understood at a very early age that you had to study, you had to do CA. I mean, in my case, I had to do CA, complete it, get a job or do something and earn money and save money so that I could kind of. Millennials don't have those challenges. They don't necessarily, many of them are well-to-do already. They earn very well. Many millennials earn in the first year what took me 5 years of my first 5 years to earn, right? So the numbers have changed, but the lifestyle hasn't changed. So in that sense, the food expense as a percentage of their earnings continues to be very, very small. So a lot of things. So they're not living for creating assets. So unlike us, they won't buy that land or buy that house. They are looking at experience. They want to travel the world, see places, meet, do stuff. So millennials is a different discussion. Actually, you should do one more session for millennials alone. And my knowledge is very limited, but to that extent, investments also will change. I don't know whether I've answered that question.
I completely agree with you on the fact that the millennials today, unlike us who did savings for the future when we do retire, the millennials today save for some event. I have a nephew who saved money just to go watch the World Cup, Soccer World Cup in Russia. So that's the kind of mindset that they have. It is going to be interesting to watch them, how they take this forward, which is what I am also experiencing with my nephews. And I just wanted to know how this transpires over the period of time, given the scenario today. That if you had any insights, I wanted you to share that. That's all.
I had no particular insights, but you're right, and they are right from their perspective. They don't need another house, right? So my brother-in-law already has 2 houses. He's going to pass it on to his son. So there is no big need for his son to buy another house and blah, blah, blah. They want to be mobile, right? So today working in Chennai, tomorrow, if I get an opportunity to work in Delhi, I'm okay. If I want to go and work for 5 years in Singapore, I want to be okay. I don't want to get stuck by paying an EMI somewhere and so on and so forth. So their thoughts are right. I mean, I do believe if we wear their shoes, we would do what they're doing. So I'm not saying they're wrong, but it's just different from the way we do stuff. So it's kind of interesting.
Thank you. Thank you very much.
Yeah, I'm Thiru here, Tirupati.
Yes.
I'd like to know about this REIT and InvIT. No? So do you have any insight on that? Actually, know how the returns are. Is it better than the fixed the debt instruments? Or
so my understanding is limited. I'm not the expert here, but I've done a little bit of homework. So REITs are different from FDs, fixed deposits of debt instruments. REITs are essentially the REITs that are listed in India, especially, are real estate based. So it will give you a combination of real estate returns in some sense, but not that of debt. So that's first important. Second is the rates are not likely to be guaranteed. The rates are more like tentative. And to start with, they will be low because rental yields are low. Even if they're commercial rental yields, they are not very high at this point in time. So I would say 5.5% to 6% on a yearly cash flow is what one will expect to start with. But the magic, like it happens in every other place, is over long periods of time. So if you stay with a REIT, and if you need regular returns over a long period of time, what happens is every 3 years, these rentals get reset. There's a real estate price reset. So the advantage over a 10-year period is what starts off as a 6% return can actually move up to about 9% over a 10-year period, right? And that's where one needs to look at returns. There are also in India REITs which are into, like you said, invest IT into power infrastructure and so on and so forth. I am very, very bullish on those assets, except that sometimes I get a feeling that government tends to intervene in some of these from a populist perspective, right? So, and those are dangers of some of these assets. It's not that these are without any dangers. There is. When you take especially these infrastructure related ITs, investment trusts, they suffer from this thing that government can come and kind of promulgate an order, capping the return for some of those and so on and so forth. So that's the risk that is there. But otherwise, I think it's one more asset class that investors need to start looking at.
Great, thank you.
This is Tyagarajan.
Yes.
Can I ask?
Yeah, please.
Please go on, Tyagarajan.
Yeah, this global funds, they come with several themes. Like, there are some fund of funds which essentially concentrate on America. And there are funds which say these are for Chinese companies or South Asian companies, etc. What is your view on that? And for a small investor, I'm not, very expert in all these funds, except the normal balanced funds and normal large and mid cap funds. But how safe it is to invest in these global funds?
So when you invest in global funds, you need to understand two things. One is your rupee investment in these funds is converted to dollar. So you're buying today what is, I'd say 70 rupees or 75 rupees. Your rupee is getting converted at 75 rupees, and then you're buying into one of those foreign companies at that thing. Right? 5 years down, when you want the money back, whatever return you made gets converted back into rupees. And at that point in time, if rupee vis-a-vis dollar is 100, then you will tend to lose to that extent. So there is there is a currency factor. And the currency factor in my mind works at about a 4 to 5% on a year-on-year basis as a negative to investors looking at overseas investments. Now, as far as investing is, between US and China, they control about 50% of global GDP and global stock market. So you will have to take exposure on either US or China, or even if you take a multi-fund which invests across the globe, a significant portion of that investment will also be in these two markets, right? That's the reality. So take it with a pinch of risk, look at it over a 5-year plus, and see how this experience pans out. Don't put too much of your money. My sense is these diversification need to be about 10% of your overall. If you have 100 rupees in mutual funds, then put 10 rupees into something like this. Wait and watch how it pans out and take your decision accordingly. So it's not going to be great returns. It's not going to be poor returns. It's just going to be a diversification away from your local market. And that's how you need to look at it.
Thank you.
Babu, this is Deepak.
Deepak.
Can you hear me?
I'm sorry.
This is Deepak. Can you hear me?
Yes, Deepak, I can hear you. Go ahead.
Yeah, Mr. Babu, it was excellent overview on global economy as well as where the India is heading in the next 10 years and how India did during COVID. I have one question on very first slide, which you mentioned. Investment is not a management, which is a managing a risk, which I agree. But what do you do for your client? When the investment goes south, what kind of, what derivatives you use or what kind of futures you use to mitigate or hedge the risk for the client?
So we don't use futures and options. The risk mitigation tool for our investors is diversification is the primary risk mitigation tool we use. So to a certain extent, most of our clients' monies are diversified across different assets, non-correlated assets. Like I said, debt, equity, gold are the primary non-correlated. So none of these assets move in similar pattern over long periods of time. Second is, part of the risk mitigation tool is to create portfolios that are not correlated, even within equities. So we try and do some more portion of non-correlated assets. So to give you a very simple answer, we look at investing in a very non-correlated way, but we don't take futures and options and we don't dabble in those because that's another level of expertise and knowledge and cost that we neither have nor do we kind of want to do at this point in time. And as a philosophy, we are long only investors. So our investors come in with an idea of a 5 to 10 year, 15 year kind of horizon. So we're not trying to kind of give them a short-term thing. And we always tell people that, you must be prepared on your equity assets to lose money in the short term and, stay with pain for 6 months time. Or 1 year time. And only then, do we give them these products. So to that extent, I don't get into futures and options and protecting the downside on that. And there's the cost attached to everything, and that's not kind of something that we would want to do.
You do mostly on the fundamentals then.
Yeah, we are only fundamental driven. We don't do this technical analysis, and we're not involved in that game at all.
When you do ETF, do you do the high leverage also, or just 1x when you invest in ETF?
No, plain 1x, no leverage, zero leverage. We're a very simple, Deepak, we're a very simple investment advice, like to keep things simple. Our investors like things simple. We address ourselves to a smallish, essentially middle class, mid-aged people. So they don't want too much of complexity in life. Simple. Yeah.
Thank you.
Incidentally, Deepak is my colleague based out of Houston, US.
Yeah. Babu sir, it's an excellent presentation, sir. This is Srikumar.
Yes, sir, Srikumar.
Sir, I just want to have the addition to what you have spoken just now. I want to know what is the percentage of split up you'll suggest stocks, a mutual fund, and the gold.
Stocks and mutual funds, in my reckoning, are very similar, Srikumar. So I kind of bunch them up. And there is no one size fits all. So there is different stuff. So I would say the 3 asset classes one needs to look at is equity. Within that, stocks and mutual fund will be within one bucket. And then debt, which is like your FD kind of products in one bucket, and gold, which is in the third bucket. So as far as gold is concerned, to a large portion of our investors, gold is limited to 10% of the overall portfolio. So that's always a given. We don't do more than 10%. Our view is gold is good at 10%. Then you have 90% that's open between debt and equity. So if you are somebody who's got a lot of assets and who you are very positive about the long term, and you want to take that risk, then you can do a significant amount of money out of that 90 in equity. So 50-60% can also be in equity. Leave a very small portion just for liquidity purposes and debt. But if you're somebody who is kind of not a regular investor, don't know much about this, I'd say, and you're 50 plus or 55 plus, then I'd say do more in debt and less in equity, because equity markets tends to have this up and down, which kind of tends to become very, it weighs on your head and doesn't allow you to sleep. Sleep is very important. So I'd say keep less of equity, maybe 40% of less, 40% or 40 or less in equity, and 50 in debt if you want to play it more balanced. So this is how, but there's no fit formula. So unless I spend time with you and, or individually with people, it's difficult to put a number out there and say, hey, this is the percentage everybody should use. No, that's not right.
Thank you. Thank you. One more question, sir. The US, there is a hike in the inflation, and there are signs are that there will be affecting the stock exchange in India, and there are going to be a sudden drop in the Sensex as well. Is it going to be like that, or how is it, sir?
So my view is very similar, sir. I think, see, US is the big brother, right? So anything that happens in the US will impact us globally. So two things are likely to happen. I could be completely wrong, so please bear this with a pinch of salt. So US has been doing these, they have been buying these bonds and injecting liquidity into the system over the last 18, 20 months. Now that has to stop at some point in time. That's artificial, and you cannot continue to kind of do. It's like it's like an artificial, inducement that has been given to the system. So they're likely to stop that at some point in time, and that can happen anytime in the next 3 months, 6 months, 1 year. So the moment they stop that, you should find a significant amount of global market upheaval. Why? Because a lot of money that was pumped into US has found its way into markets like India. The moment you stop that funding, Indian markets will start seeing a reversal. Money will start flowing back out. And when that happens, you will see Indian stock market go through a little bit of a pain. So we have to be always prepared that there will be some pain in the next 12 months in India. Second is there is an inflation, like you mentioned, in the US. The way to counter inflation is to raise interest rates. Now, in the last 20 plus months, interest rates have been systematically cut down to an all-time low. They will have to raise interest rates to kind of curb inflation. When they do that, the markets will struggle more, because when you raise interest rates, money that was lying in, that was borrowed and pumped into stock market will move back out. So there will be a reversal in stock market. So I would say, to answer your question, yeah, 10, 15, 20%, up to 20% market correction is entirely possible in the next 12 months. And globally, US, India, all of it is the thing. I don't think one needs to be worried about it. I think it's a healthy trend. Markets are meant to go up and go down. The only thing is, over a long period of time, if the upward movement continues to be steady, one needn't be bothered about it being down. So that's my point of view. And very difficult to predict exactly when this will happen, by how much it will happen. Impossible. So I don't try and think, except that from a mindset perspective, as long as we are clear that, hey, I'm okay with about 15% correction in the market, I don't think I will lose sleep, or my wealth is not going to be completely eroded, so on and so forth. We're in a good place.
Thank you. Thank you very much.
Hi, sir. This is Om Kumar.
Yes, Mr. Om Kumar.
Yeah, sir. I as you said, I also believe the next multi-bagger sector will be from semiconductor industry, or from EV theme, or fintech companies, or from any renewable energy sector. So, do you have any particular stock in your mind that will give multi-bagger returns in these sectors for the next?
Unfortunately, I'm not into specific stocks. So I'm more into funds and so on and so forth. And I have honestly no particular favorite in this. I'm as naive an investor as you are in this.
Okay, sir. So from my experience, I found one multi-bagger in the last year as a Brightcom Group IT company that gave 12x return for me in the last 1 year.
Super. Then I need to touch base with you and get some tips. That's the other way around.
Definitely, sir. And in crypto space, sir, so you covered cryptocurrencies and NFT. And one more area is metaverse platform, where is the huge potential. Even Facebook is finding investing in that space. So if we invest in this space like Mana cryptocurrency, we will get some very good multi-bagger returns.
Absolutely. Absolutely.
Thank you. Thank you.
Thank you.
Mr. Babu, is there any particular fund manager you would recommend for us?
In the sense?
I'm sure somebody who does that fund management for you. There are many I know, but is there somebody which comes to your attention because you are in that space? You would have met or spoken to someone who can help us through managing our funds. Is there somebody you would recommend?
There is one very good fund manager that I know of who I see every day morning in the mirror. His name is called Babu Krishnamoorthy, and he runs this Fincherpa Investments Private Limited.
I didn't know that.
But jokes apart, if you connect with me offline, if there are any specific stuff that you want, which I think I know, obviously I'm not the only guy. I'm not claiming that. There are other people available. I'd certainly kind of put you through whoever will work for you. Absolutely.
Sure, I'll do that. I didn't know this. Sorry about that.
So do reach
Any
out.
questions?
I just kind of put my connect here. Just send me a mail. Happy to kind of spend some time and help you if there is any way I can help you with. babu.k@fincherpa.com is my email. Happy to kind of share insights if I can help you in whatever way. Absolutely happy.
Anyone else has a question now? Sandil Kumar, please go on.
Told the webinar that price of crude has got a huge impact on our economy, and the recent past we have been seeing a lot of companies emerging into the renewable energy business. When we'll be having less dependency on the crude, when we'll have a better economy without the impact of this crude price. So and after how many years? What is your view on?
Good question, but my sense is the next 5 years you should see a significant beginning happening in that. So two, three things are happening in this, and I just want to share my learning in this is that because crude prices are so strong and so impacting our economy and our products that we buy and thing. So a certain amount of EV adoption is happening at a much faster pace in India. So you will find even in cases of low budget items like bikes, the EV adoption is going to be quite significant. I wouldn't be surprised if 5 years down, 2025, electrical vehicle sales outnumber the conventional combustion engine vehicles, right? I wouldn't be surprised. And let me tell you, 99% of people who buy bikes in India travel less than 20 kilometers in a given day. So, and it's the ideal thing for bikes. It's not like they're going 350 kilometers one way, so there is no charging point, charging infrastructure. So a lot of this movement towards EV will also reduce demand for fuel. So it is going to happen naturally also. Plus, we're a country with abundant solar, right? And I do expect a big change in solar. I mean, Reliance has already announced a huge mega investment into solar. And I expect the private sector to participate big time. Now, once, it's always the first movement that's difficult to happen. Once it starts moving, once the economy starts working, then you find that the per unit cost drops quite significantly. And then adoption becomes quite easy. So 5 years down, all of us will have solar water heaters. It's unimaginable to pay fuel to heat your water, especially in a place like South India, right? Where you have abundant of sun and abundant of solar. To pay to heat your water to electrical companies is kind of criminal, so to say. So I do expect a lot of change to solar, electric vehicles, and a host of this will naturally bring down demand for crude. And hopefully by then, globally also crude prices will drop, because it's always a supply demand issue. So I do think I'm very confident in the long term, we will not be dependent on crude to the extent we are today. But to put a timeline, I'd say safe is a 10-year period, but you should start seeing significant difference in the next 5 years. Does it answer your question, Cindy?
Yeah, thank you. Thank
you. Any further questions? I think we are done, sir. Sir.
Yes, thank you, Mr. Gopi. Mr. Gopi, have you identified 2 people who are going to be the beneficiaries of this book?
Yeah.
Yes, please read out their names, and then I'll get the address from you later. But if you can please announce so that.
Yeah, you can give one to Mr. Tirupati Armugam.
Mr. Tirupati, you have my claps. Yes, sir. The other one.
The other one, I thought I'd give it to Pratap, G. Pratap.
Mr. G. Pratap.
Thank you, sir.
So Mr. Tirupati and Mr. Pratap are the lucky winners who are going to get this book. So look out for this book. It should be in your hand if you're anywhere in, it will reach you by courier next week sometime. And look forward. Thank you so much.
Looking forward to get it, sir. Or if I can come to your office and get it, I'll be happy to do that also.
You can, absolutely.
Thank you.
Thank you very much, Mr. Babu. Excellent session. We had a lot of takeaways from it.
Always a pleasure, sir.
So we'll catch up soon. We'll try to catch up one of these days. I'll give you a call and come.
Absolutely. So can I take leave, Mr. Gopi?
Please, sir. Please go ahead.
Thank you very much.
Thank you so much.
Thank you very much.
Thank you. Wish you all a very happy New Year in advance, and have a great weekend.
Thank you, sir.
Thank you so much. Thank you. Same to you, sir. Bye.